In this video, I'll be helping you get a high-level understanding of plain vanilla bonds. I'll start by explaining their main characteristics, and then I'll take you through the basic valuation process. Plain vanilla bonds are also known as conventional bonds or level coupon bonds. The plain vanilla term is common in financial markets. In the case of bonds, it means that the bond has no exotic features, such as an embedded option. Such a bond is a financial instrument which represents a contract between the issuer and the bondholder. The issuer borrows a specified amount of money called the par or face value from the bondholder. In addition, the issuer promises to pay back the money on maturity date. Finally, the bondholder also promises to pay a fixed annual interest rate called the coupon rate. The rand amount of interest payable each year, called the annual coupon, equals the coupon rate times the bond's par value. Very often, the annual coupon is paid out over the year in installments. Therefore, the bond's terms also specify the coupon frequency. Typically, this would be annual or semi-annual, although quarterly or other frequencies are possible. On the previous slide, I drew attention to the fact that the bond has a coupon frequency and a maturity date. This allows you to set up the timeline. The notches in the timeline are spaced apart according to the coupon frequency and are not necessarily or simplistically at one-year intervals. The timeline ends, obviously, at maturity date, shown as time n. The cash flows at each intermediate notch on the timeline are calculated as the coupon rate times the par value times 1 over the coupon frequency. The final cash flow consists of one of these coupon cash flows plus the par value, which is repaid at maturity. Having set up the timeline and allocated the cash flows correctly to each notch, the final step is to determine a value. This is determined on the basis of a discounted cash flow approach. Therefore, you need a discount rate. Bonds are marketable financial instruments, and they trade in fixed income markets in much the same way as shares trade in equity markets. And in the same way that the price of a share changes in response to changes in market perceptions about the company's fundamentals, the price of a bond also changes, but in response to changes in market perceptions about the company or government issuers' credit risk rather than its dividend growth or beta characteristics. The market price of a share is published in rands and cents. Bonds are different. Although the price can also be quoted in monetary terms, there are a number of reasons why it is also convenient to look at the valuation from a somewhat unfamiliar point of view and to quote the price in terms of the market discount rate. Also known as the market yield or current yield to maturity, the market discount rate is the rate that discounts all of the bond's future cash flows, its coupons and par value, to the current price, in rand terms, of the bond. Therefore, a bond's price could be specified as a money amount or as a yield, and you need to know how to work out either of these given the other. Let's look at an example. Calculate the value of a 1,000 Rand annual pay bond with a 10% coupon rate that will mature 4 years from today. Assume that the annual market yield is 8%. In order to set up the timeline, you identify that the bond is annual pay, so the notches are 1 year apart. The maturity date is 4 years away, so the final notch is at t equals 4. Next, you apply the coupon rate to determine that each intermediate cash flow is 10% times the face value of 1,000 Rand, so 100 Rand each. Note that there is also a coupon payment at T4. Finally, also at T4, the par value is repaid by the issuer. Applying standard TVM principles as shown in the equation, each cash flow is discounted at the current market yield of 8%, taking into account the timing of that cash flow at T1, T2, and so on. Once you have gained an understanding of the cash flow pattern, it is much more efficient to use the TVM functionality of a financial calculator with the inputs shown on your screen right now. Notice that the calculator algorithm deals correctly with the fact that the final cash flow combines the last coupon as well as the principal repayment. And to end the video, one more example. 4 years ago, a 10-year semi-annual pay 100,000 Rand bond was issued. It has a 9% coupon rate and the current market yield is 11% as a bond equivalent yield. Calculate the value of the bond today. This time, the bond is semi-annual pay, so you know that the notches on your timeline will be 6 months apart. In order to determine the maturity date, you note that the bond had 10 years to maturity when originally issued. However, 4 years have since passed, so the bond is 6 years, or more specifically 12 6-month periods away from maturity. Also, because the bond is semi-annual pay, you know that the annual coupon is divided into 2, such that each coupon amount will be 9% times the 100,000 Rand face value times 1/2, which is 4,500 Rand. Finally, you are aware that the bond equivalent yield is a stated rate compounded semi-annually, so the per 6-month rate is 11% divided by 2, or 5.5%. Plugging these numbers into your financial calculator enables you to determine the bond's current Rand value.